Guys, welcome back to the channel. In today's video, we're going to be talking about inflation and the impact that it can have on you. So there was an article that actually came out about a day or two ago. The Fed is saying that they could raise inflation as much as 0.75 basis points with a 75% probability, or up to a 1 full percent basis point increase, which is going to be absolutely crazy if we see a full 1%. It's been a number of years. Now, with the inflation, a lot of people hear about inflation. They hear about the Fed's rates. They hear about a lot of things of that nature. But what is the actual impact to you? So what is happening through inflation? You know, it has slowed slightly through the last couple months, but it is still high, guys. Inflation is around 8.3%. The Fed's want it at about 2%. That is right, guys. It is about 4 times the average of what the Fed wants to have the inflation rate at. Now, why does that matter to you? As interest rates go up, it is more expensive to get everything, guys. If you've looked at mortgage rates have almost doubled in the last 6 months. Credit card companies continue to increase their rates. If you're looking for a new auto loan, if you're doing unsecured lending, if you're doing any lending at all, the rate that the Fed rate is what banks do set their own rates at, which means it is going to be more expensive to pay for things. In addition, guys, it is a lot more expensive if the institutions, let's say the banks, if anyone needs to borrow money to, let's say, build a new location, to hire additional staff for expansion, now the money becomes incredibly expensive. Again, almost doubling in the price that we've seen years ago. And then you couple that kind of with the COVID time, with the supply demand issues, also the ability to get us goods and services that people are looking for. It's kind of a unprecedented time out there. So what does it really mean to you? Consumer prices, the CPI, the Consumer Price Index, has increased an incredible amount. We've seen food prices going through the roof. We've seen gas prices going through the roof, but it also has a detrimental effect to stocks. Company stocks usually see a big decrease when the Fed continues to raise rates, because again, for companies, it is more expensive for them to get money. Now, not all is really doom and gloom. We've seen June was 9.1 inflation, then it went down slightly in July, and now August was 8.3. So inflation is moving in the right direction. So you might ask yourself, why is the Fed looking to increase this rate, or to continue increasing the prime rate? It's because inflation, they feel, is not moving fast enough to get back to that 2%. So instead of having kind of a slow, steady decrease that we would normally see within the market, you might see sharp up and downs that will ultimately come from the Fed adjusting the rate. So essentially, if the Fed goes 1 full percent, everything is going to get more expensive. Mortgage rates are going to go up. Auto loan rates are going to go up. Credit card rates are going to go up. In turn, a lot of people will not have the discretionary spending to continue to buy everything they have, which again sends us kind of in a recession. So right now, guys, technically we are in a recession. What that means is 2 quarters of negative growth to the GDP, or the gross domestic product, as it goes down. But we are literally just under the rate or the negative growth. I think it was like 1.1 if I remember reading an article. It was roughly 1.1. I believe even the quarter before it was a little bit less. So ultimately, guys, the government seems to be kind of driving us into an inflationary period, is what we're seeing. Again, the big impact, of course, that we see within our personal lives is the price of goods, the price of services. If you've bought in everything, even larger ticket items, they're incredibly expensive. Now, during inflation, guys, your dollar has less purchasing power because they make everything expensive. And this is by design. This is one of the major jobs, or one of the primary functions of the Federal Reserve, is to really offset the ability of people to buy goods and services based on interest rates. Again, if they make things more expensive, you're going to buy less of it. And that essentially is the theory. Now, a lot of things that kind of go into effect of this. One of the big things, guys, inflation is because of COVID. Economic shutdowns throughout the US, throughout the entire United States, millions of people were laid off, many businesses closed. If you've looked even locally, a lot of restaurants have closed, a lot of institutions have closed. There's been a lot of different places that are done. Again, supply chain issues, we hear about this a lot in the news as well. Supply chain issues, getting the products and services. If you go to your local retailer, if you go to your local supermarket, a lot of times a lot of the shelves are empty, or products that you've seen before are not available. And we'll never forget the toilet paper shortage that people had for an incredible amount of time. So again, why is the Fed raising the rates? So the Fed aims to slow down the economy, again, making things more expensive. Consumers, investors, businesses pause making investments. Credit cards, of course, are driving up the rates, guys. If you have higher rate credit cards, you need to consolidate that debt. We've talked about it a lot on the channel. We had a lot of people who were even doing open lines of credit, home equities, interest-only home equity products, things of that nature that are open line with a variable rate. If you have a variable rate, guys, the Fed has came out and said, we're going to raise rates. We don't know by exactly how much until they announce it. But essentially, the money that you're borrowing, or the money that you do have borrowed, is going to become more expensive, which means that your payments are going to go up, allowing you to not buy additional things or save money, invest money, whatever it may be. So there has to be a budget adjustment when it comes to things that are more expensive. So honestly, guys, summing it all down, what does it mean to you? Looking at, 2019, 2020, 2021, rates were held low, and they were held by the Federal Reserve. The interest rate, the prime rate, was incredibly low, making things cheap. We had 10-year mortgage rates at 2%. We had 30-year mortgage rates at 2.5%. Now you look at the same 30-year mortgage rates, they're around 6%. So if you're looking at, let's say, a $500,000 house, because the prices have literally gone through the roof, just the price difference between those two rates is roughly $600 a month. So a lot of people, again, that could afford that $500,000 house at 3% can no longer afford it at 6% because of the payment. It also means with higher rates, guys, there's less incentive to refinance your mortgage, less incentive to refi your student loans. And then, like I've said before, guys, credit card debt is going up, but credit card rates are going up as well, which is incredibly, incredibly hard to do. Also for you guys, if you've looked at your 401k, if you've looked at any of your investments, as well as any of the investments you might have in crypto, there's a big negative effect when the Fed's raising rates. Now, if you're looking at investments, things of that nature, guys, it is a long-term game, which essentially now, in my opinion, not financial advice, would be the time to buy, because you have to think you're buying everything 17 to 20% off, which it could go down a little bit more, again, depending on what the Feds do. But ultimately, guys, you want to buy when the market is down and sell when the market is high. If you're doing that, most people will just buy and hold for the long term. Remember, the S&P 500, or the stock market, yields roughly 8 to 10% return on an annual basis over a 10-year period, which is when you want to do the investing. All right, guys, so I hope it helped a little bit to kind of see what is going on with the market and how it does impact you. Again, guys, if you have any variable products, whether it be home equities, whether it be credit cards, loans, whatever it is, make sure, guys, that you're locking in those rates, because we could see them increase significantly, which means it's going to impact the payment that you are making. Guys, that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.